This is our presentation having to do with estate and business succession planning. The moderator is Matt Ahern. Matt is another one of our triple gators with Dean Meade. He has his undergraduate, his law, and his master's in taxation from the University of Florida. Matt is really one of the mainstays of our estate and succession planning department in the Orlando office, and is the primary editor-in-chief of our new estate and succession planning blog, which I'm sure is reference to or in the materials that you have, and there'll probably be some comments about the blog. Matt, if you'll introduce the rest of your panel.
Thank you, Michael. I'm pleased to have with me on the panel, immediately to my left, we have Terry Burdine. She's with McLadry. She's been a partner there, and she has 20 years of accounting experience. She does tax consulting and compliance work and does a lot of work with agricultural interests. She assists her clients with business issues, succession planning, acquisitions, and dispositions of businesses and product lines. And she is a Golden Knight from UCF with an accounting degree. Over here is Ken Seebach. He's a wealth advisor out of Palm Beach with Wells Fargo, and he handles a number of significant clients, including agricultural interests for Wells. He is also a licensed CPA, former tax director with HSBC, a CFO with a private equity firm, and former tax consulting manager with Arthur Andersen. And he is a Gator from UF, also with an accounting degree. So for those of you who have stuck around this afternoon, you're in luck. You have a panel with 2 accountants and a tax lawyer.
Sounds like the start of a joke.
So our topic today is estate and succession business planning, and after some discussion we decided that we needed to narrow that topic down just a bit, given that we have 30 minutes of your time this afternoon. So we decided that we were going to talk on the 2010 Tax Act and planning opportunities under the Tax Act in 2011 and 2012. So Terry, would you go over the rules of the 2010 Tax Act for us?
Sure. I want to make sure the slide comes up so that... Oh.
Somebody has
all right, great. Okay, as you can see on the slide, we've basically summarized the estate, gift, and generation skipping transfer tax exemptions, rates, and the effective dates. Obviously, for the 2010 laws, those have now passed, but for some of those estate returns that are now being filed, we thought this information would be useful. The estate tax exemption was at $5 million and a 35% rate. The gift tax was at $1 million and a 35% rate, and the GST exemption was the same as the estate tax, and the exemption amount of $5 million with a 0% rate. Come 2011, which is the year we're in now, and also for 2012, we can see the reunification of the estate and the gift tax at the $5 million mark. And then the tax rates across the board are 35% for those 3 for 2011. And then the $5 million for 2012 will be adjusted for inflation. And then 2013, the law reverts back to what it was previously before Obama passed the extension of the Bush tax extenders. And it goes back to $1 million and 55% for all 3. So 2011 and 2012 pose an opportunity for those who are looking at some estate tax planning and some succession and gift issue planning. It applies from January 1st of 2011 through December 31st of 2012. The estate, gift, and GST exemptions are all $5 million. And they've been reunified, and what that means is that basically they've set the gift tax exemption at the same as the estate and GST exemption. Beginning in 2012, the $5 million estate, gift, and GST will all be indexed for inflation back to 2010. We're not sure what those numbers look like yet, but you can see that they're going to push those up just a little bit. And the estate, gift, and GST tax have an effective flat tax rate of 35%. Also, what we wanted to mention, which does not apply to this 2010 extender, but are still out there, those benefits are still out there, is the Code Section 2032A, which is a special use valuation, which talks about qualifying real property used in a family's farm or a closely held business may be discounted up to $1 million of its property value for its current use instead of its highest and best use. And that can be discounted annually for COLA, which is currently $1,020,000, and it has 10-year 2032 recapture applies as well. And then also is the deferral of the estate tax under Code Section 6166, and I'm sure I'm just completely mesmerizing you guys with these code sections. But basically, the estate tax on closely held businesses that exceeds 35% of adjusted gross estate tax may be paid over 15 years with 4 years interest-only payments, followed by 10 years of installment payments. And that allows also for the acceleration of estate tax if disposition of interest occurs. So we just wanted to highlight these two things because they are still out there, and this does apply in a lot of closely held real estate type family businesses.
So next, we wanted to highlight to some level what we believe creates a huge opportunity right now. I have to put a spin here after lunch on death and taxes. And thinking across the presentations that I've heard from this morning, they've really painted a picture of a number of the challenges that we in the ag industry face. And bridging from my colleague before lunch, Dr. Swanson, his economic outlook, he painted a picture of huge economic and global volatility, and really that there's not really a whole lot we can do about it, but we can look for opportunities, little opportunities here and there, to take advantage of the situation that we're in from the overall broader economy. So we're trying to take Dr. Swanson's dark storm and put some silver lining on those clouds that we have. And again, we're trying to do that with death and taxes here. It can be a challenge sometimes. But I want to focus first. Most of you understand the estate tax laws, I think. The current markets that are in place right now, there's a significant depressed value for a number of properties that family businesses own, including some ag properties. There's no secret that you see a significant amount of volatility in the values in the economies, the financial markets, commodity prices, and in interest rates. That combined with low interest rates that we see present, historically low interest rates, the 30-year mortgage, for instance, as you all probably heard, is at 50-year lows. The 10-year Treasury is at the level of the 1940s. So those two factors combined make for an ideal environment to consider the estate planning transactions and ideas that we wanted to present to you today. Generally, for estate planning purposes, just to set out some general ideas, lower values equal lower transfer values for estate tax, and using the exemptions that Terry mentioned before, the $5 million per person, we can put more assets through those exemptions through some of the planning techniques that we're going to illustrate. Also, interest rates, generally the lower the interest rate, the better off it is for estate planning purposes. So I'm going to bridge from that back over to Matt.
And just getting back to the values and the interest rates, it's been my experience that when the interest rates are going up, the values are going down. There's a lack of credit, lack of demand for the values. And if the interest rates are going down, there's more credit, more demand, and the values are going up. So I think we are in a very unique time in our history where both our values of properties are significantly depressed and our interest rates are at historical lows. And those two things combined together make this a very unique period in time. And in fact, the IRS puts out interest rates below which will be considered a gift in certain transactions, and they set the bar for that. And their rates for next month in October have reached historical lows, and they've been publishing those since 1952. So there's a lot of transfer tax opportunities out there, especially if you feel that these values are going to appreciate over time. But we didn't want to talk strictly about taxes for the entire time here today, but we're going to go through some illustrations in a minute. And when we usually have discussions with our clients, we usually talk in terms of children and descendants. But we're typically not talking about leaving gifts directly to children and descendants. We are strong proponents of the use of trusts in our office, and there's a number of reasons why we are. The first of which is that through trusts, your clients can name the trustees of those trusts and control the gifts. So if we have any, so we say, problem children, those can be controlled in that way. We can also ensure that gifts that are left to children stay within the family lines. So the assets that are left in trust under our current trust laws will be protected from going to, say, your ex-spouse, and I know there's a joke somewhere in there about outlaws. So you want to keep it in the family, keep it in a trust. If any of the beneficiaries of trust ever get into creditor problems, our trusts are designed as what we refer to as Spendthrift Trust, which means creditors cannot attach a beneficiary's interest in the trust, and they cannot force the trustee to make a distribution from the trust for the benefit of the beneficiary, so they are creditor protected. And also, we can use what we refer to as generation skipping exemption. It's basically an exemption of the tax laws where we can remove this property from the estates of children and descendants for as long as 360 years in Florida. So we take it right out of the estate tax system so that the tax problems that our clients are dealing with now, they're not going to be the tax problems for their children and their children's children. So these are things that I think if our clients could do for themselves, they would, but they're not allowed to under the law, but they can do that for their children. So we're very strong proponents of trusts in our office. We're going to run through some illustrations under 2011, 2012 estate work as well as gift planning, and we're going to use this case study as a model. So we've got Larry and his wife Louise. They're landowners. They have a ranch. It's worth $12 million. They have $750,000 of cash and $250,000 of other assets. They have no debt, so their net worth is $13 million. The ranch produces an annual income of $300,000. They have 3 children and 7 grandchildren. And Ken, would you like to go through this illustration that we have about estates in 2011?
Sure, yeah. The next couple of slides that we're going to go through are going to build on the case scenario that Matt just mentioned. And they're really here for two purposes. One, to illustrate kind of a base case, simple, what we call portability, which is a component of the new 2010 law. We sometimes call that do-nothing planning. If you haven't done anything in terms of wills or trust, this planning, or I should say simple wills, but with no trust, this is an illustration of how a scenario could actually work out. This will actually also illustrate a base case for the advanced techniques that Terry and Matt will speak about later. But in this scenario, as Matt mentioned, with simple wills, Larry and Louise own $13 million, have a joint estate. The wills state anything that they own goes to each other, and it illustrates what happens if both spouses die in 2011 or 2012 with portability. So if you look at the left-hand side of the screen, at the first spouse's death, half of the estate is picked up, and there's no estate tax on the death of the first spouse due to the portability and the marital deduction. The assets that are deemed to be part of that first spouse's estate qualify for the marital deduction. They pass over the right-hand side to the estate of the surviving spouse. The column on the right-hand side illustrates the estate tax calculation at the death of the surviving spouse. So assuming that there's been no appreciation in the value of that of the estate from the death of the first spouse to the death of the second spouse, the total estate of $13 million, there's no more marital deduction left. The tentative estate tax at 35% on that estate is $4.53 million. There's an estate tax credit of $1.73 million, which is equivalent to the $5 million exemption that each person has, leaving a tentative total tax due of $2.8 million. And you have the unused credit. The first spouse did not use estate tax credit, did not apply through any AB trust planning. Use of the estate tax credit, that credit equaling $1.75 million. So there's a total tax due in this scenario of $1,050,000. And what I'm going to point out here, and going to the next slide, pay attention to the tax due at the bottom of this slide, $1,050,000, and we'll compare it to the tax due at the bottom of the next slide. the same amount. This slide assumes the use of what we commonly refer to as relatively simple AB trust planning, a credit shelter trust planning. In this scenario, we also have Larry and Louise, the $13 million joint estate, but we've done planning that incorporates the use of a credit shelter trust. You see on the left side of the page, at Larry's death, assuming Larry dies first, $5 million of the $6.5 million by the design of this plan flows into the credit shelter trust. Again, that $5 million is the max amount for gift transfer tax exemption, and the remainder of $1.5 million flows outright over to Louise through the use of the marital deduction. Now, to back up, following down the left side of the page further, the terms and provisions of the credit shelter trust are such that all of the income from that trust goes to Louise, and principal is needed. The trustees are directed to distribute assets in that way. At the death of Louise, those assets flow to the beneficiaries of that credit shelter trust, typically their children. Going across the page there at the bottom to the right, death of the first spouse, the total estate is $6.5 million. $1.5 million was transferred over to the second spouse, Louise, by marital deduction. The estate tax was $1.73 million, and that was fully offset by the exemption equivalent tax credit of $1.73 million. So following further to the left, Louise at this point has an $8 million estate, again assuming no appreciation. That $8 million total estate receives no marital deduction again, and has a tentative estate tax of $2.78 million, which is offset by Louise's estate tax credit. So again, leave $1,050,000 total tax due, the same as under portability. Again, the portability we would view as the do-nothing planning. I think the bottom line here, just to cut to the chase, is we wouldn't recommend that any clients rely on portability to essentially get to the same answer. You note that one of the points of the portability is listed on this slide is it only applies to 2011 and 2012 descendants. After that, it's anybody's game as to what happens, or anybody's guess as to what happens. And as noted, it really is a stopgap to bad planning. There are provisions that need to be taken into consideration, that requirements such as filing a death tax return, a estate tax return, Form 706, which is an added complexity that might not otherwise need to be required. I'm going to move on to the next slide, just very quickly illustrating the pros and cons of portability versus trust planning. And again, portability is really just a fallback position to what I would consider to be overall poor planning. It's easy, it's direct, and again, a remedy for doing nothing. The cons, again, 2011 and 2012 only. The portability is not indexed for inflation. You're relying on executors, some of whom you don't know, possibly, and you have to rely on their ability and judgment to do the right things after passing. I mentioned appreciation. It has no benefit for appreciation from the time of the first spouse's death to the time of the second spouse's death. And it doesn't apply for the GST exemption. And with the advanced planning that Terry and Matt are going to talk about, they utilize a GST exemption, another realm of the transfer tax system that can be extremely, extremely valuable. This doesn't take into consideration the GST exemption that would otherwise be available. And again, the estate tax return must be filed as a con. So just to illustrate one more scenario before we move on from this, assuming instead of the first two scenarios where spouses both died in 2011, 2012, you focus here on the benefits of doing planning with a credit shelter trust, minimal planning versus using portability. You see focusing down on the bottom right, there's a $2.9 million savings because we're assuming that we didn't take advantage in this scenario of using a credit shelter trust. So the bottom line from this is through some very simple planning and not relying on the fallback position of the portability, there can be significant estate tax savings.
Thank you, Ken. You know, a lot of our clients, you know, don't like to go through the complex planning, and so we wanted to just address and make sure that people understood that we don't feel that portability is a good substitute for adequate planning. And I understand that sometimes dividing the assets between husband and wives and setting up trusts after the death of the first spouse are viewed as unwanted and perhaps unnecessary steps in a plan. But there's really some major drawbacks on relying on portability, which is where the first to die spouse's estate can transfer any unused exemption over to the surviving spouse so that the surviving spouse can use it. And as Ken addressed, there's really no appreciation built into the ability to transfer over that exemption, where a credit trust can grow outside of the surviving spouse's estate, and you can't exempt it from the generation skipping transfer tax. So this isn't good when you're doing kind of generation skipping planning as well. So there are other technical problems involved with that, but I just want to make clear that portability of exemptions isn't necessarily all that it's cracked up to be. It's certainly not a panacea replacement for proper trust planning. And now moving on from the structuring of wills and trusts for clients at their death, where I think Larry and Louisa now realize, after seeing some of these slides, what the tax liability could be. Even with proper AB trust planning, there's still $1 million of tax to pay, and they've come in to see us to discuss what they can do about that. And as a precursor to that, we've set up a partnership to own the ranch property, and we've called that the LL Ranch Limited Partnership. And the reason we did that is we wanted to have the control over the ranch limited in a small fraction of the overall value of the entity. We'll call it the general partnership interest, which would typically be 1% of the value, which has 100% of the control of the entity, and we're looking to transfer some and up to 99% of the value of the ranch. That would be represented by the 99% limited partnership interests to children and other descendants. One of the major benefits of transferring limited partnership interests is we're going to be able to take account of valuation discounts. And those are primarily minority and marketability discounts. And under the federal tax rules, you value property under an objective test that we know as a willing buyer, willing seller test. It's what a willing buyer would pay a willing seller, both having reasonable knowledge of the relevant facts and neither being under compulsion to buy. Well, a buyer is not going to pay full price for an interest that they cannot control. They have a minority interest, they have no vote in the management of the ranch, so they are going to ask for a discount off of the value of that interest. In addition, once they buy that interest, they're not going to be able to get rid of that interest or turn it into cash very easily. These are restricted interests. They can't go to the New York Stock Exchange and sell these interests and take cash. And so there is a lack of marketability. So they're going to take another discount off of the value of those interests to reflect the fact that they will not be able to cash them in and without cooperation with the other partners of the partnership. And these discounts can be fairly significant. And so we've set up the ranch in this partnership. They'll retain the general partnership interest, and we've got some planning techniques that'll go over transfers of limited partnership interests. And Terry, would you like to go over those slides for us?
Sure. Okay, so what we've done is we've made a few assumptions. One is that we'll transfer approximately 60% of the ranch interest into the limited partnership. So if you remember in our example, that was valued at $12 million, so that, doing simple math, would get us at $7.2 million. And then talking about the two discounts that Matt just alluded to, we would discount that amount by 40% to get us to a total gift of $4.32 million. Under the current tax exemption, gift exemption laws for 11 and 12, we can actually exempt that entire gift up to $5 million and pay no gift tax due. But as you can see in the column on the right, the gift tax exemption will only go to will drop to $1 million in 2013, so therefore we'll have significant gift tax due of $1,671,000 in 2013 and beyond under the current law. So that's why this time period right now in 2011 and 2012 is the time to kind of get organized and realize, hey, if we're going to do these transfers, it's sort of a perfect time, one with low property values, low interest rates, and then obviously being able to discount it under the two methodologies. We could also do an installment sale to a grantor trust, and with that, 1% of the general partner being the Louise and Larry owning that 1%, the 99% going to the other affiliated family members as they deem necessary. We'd have an initial gift of seed money of $432,000, and then what would happen is we would sell 60% of the limited partnership interest to the Larry Landover Dynasty Trust, and the beneficiaries would be the decedents of Larry and what was her name? Louise. So we have a promissory note of 4.32 million secured by the partnership interest, 60% of the partnership interest. A 9-year interest-only note, the annual revenue or expense, depending on which side of the fence you're on, would be $51,400. And then if it's a greater than 9-year note, meaning that it would classify from a midterm rate to a long-term rate under the applicable federal rate to annual federal rate tables, would be $127,000 approximately. And as you can see below on the left, the purchase price of the stock, $12 million times the 60% sold gets us to the 7.2, and then discounted down to the $4.32 million dollars that we have for the sale of the interest.
All right, the installment sale transaction, Terry, is really nothing more than giving a really, really good deal
Right.
to the trusts for your descendants. And an important point about all of this is initially we make a gift to these trusts because you wouldn't sell anything to a trust that didn't have any money, and so we want this thing to have substance with the IRS, so we call it a seed gift, and we usually make that gift in at about 10% of the overall sale price, so we have some substance in this trust. We call this a grantor trust because it's a specialized trust under the income tax rules where it's really a disregarded entity. The transactions between the trust and the grantor of the trust are disregarded for income tax purposes. So when we sell something to the trust, it's like you're taking it out of one pocket and putting it in another for income tax purposes, so there's no gain on the sale of these interests to the trust. It's good for Larry and Louise that they'll be able to receive a cash flow back from the assets that are sold to the trust pursuant to the note. And when the trust pays back these interests on the note, again, it's a grantor trust. There's no income taxes on the payment back on the note. So we have a completely disregarded transactions where they're receiving, hopefully there's enough cash flow, and we've got $300,000 from the ranch to pay for this thing, that they'll be able to pay off this note over time, receive some cash flow. Hopefully we've sold at a low point, because now the asset, which is in the limited partnership, 99% represented by the LP interest, they get to grow in this dynasty trust, which will be outside of the estates of children and grandchildren. And they've limited the appreciation of what they've taken back in return to the interest rate that's on these notes, which are at historical lows. So this can be an extremely effective transaction to move a lot of money and still keep some interest coming back to Larry and Louise, who they haven't gifted away their property. They've sold it and retained a note. They've essentially changed a property that may appreciate more in exchange for a note. And in the process, they've taken significant minority and marketability discounts on that transaction.
Right. And actually, the transaction itself is typically very simple to explain to clients. Mm-hmm. It seems complex, but once you kind of sit down and show all the facts and circumstances, it's actually very simple to invoke and make it happen.
And so I think we just want to conclude with really three main points. And one, portability was thought of the panacea for not having to do trust planning, and so there's a lot of weaknesses with the use of portability, and I think Ken helped us go through those, and so we do not recommend relying on portability. The AB trust plan is still the best way to take advantage of the exemptions, and so that's important to continue to have in your estate planning documents and not simply rely on simple or sweetheart wills where all property is transferred between spouses. The second point we wanted to make is that it's an extremely unique period of time. I know there's a lot of fear and trepidation right now, the way the economy goes and the wild swings in the market, and I really don't want to go back to the office and see where it ended up today. But what that means for transfer taxes, if you have an optimistic view of the future, that property will appreciate over time. Their values are incredibly depressed right now. In addition, it's very, very low interest rates, and having low values and low interest rates at the same time is a unique circumstance, and it's something that people can take advantage of. And the third thing is we do not know what the future holds with respect to the estate and gift taxes. Okay, I'm sure, as all of you know, our government needs money. Okay, and they have this debt super committee, in fact, that is supposed to come up with $1.5 trillion of budget reduction. All right, they are supposed to produce their report and give it to Congress by November 23rd. And then Congress is supposed to go in an up or down vote on that by December 23rd. That has caused some people in our area to become concerned of whether there might be some changes in the law this year rather than next, because as we've said before, we know that what's currently on the books expires at the end of next year, but could there be something that happens even earlier than that? And so we're looking at things that have been on the table as possible changes, possibly making it into the law even earlier than that. And those things, and the biggest one really that concerns us is valuation discounts. The IRS would love to get rid of valuation discounts. It has been an extremely effective tool of transferring wealth from one generation to the next, and people have been extremely successful in defending valuation discounts at tax court. And so they would love to legislate away these valuation discounts. And there has been legislation in the past that was designed to do away with valuation discounts for inter-family transfers. And so when we see the current environment where the government needs money and we have the estate and gift tax system, there's a lot of uncertainty right now, and perhaps new rules regarding elimination of valuation discounts isn't considered a new tax. That would be against what the Republicans would want. Perhaps this is considered closing a tax loophole. There are other things that we haven't discussed today. There's been talk of doing away with short-term grant to retained annuity trusts. That's kind of beyond the scope of what we're talking about here today. There's also been discussion about shortening the length of time that property can be held in trust and exempt from the estate tax system. Right now it's an unlimited period of times, and a number of jurisdictions have extended, like Florida, 360 years, Nevada, 365, unlimited in Delaware and Alaska. You can hold property outside of the estate tax system. And so perhaps the government is looking at reducing the period of time with which property could be exempt from estate taxes. So there's all these things out there which give us concern that the current unique environment with the increased exemptions and valuation discounts aren't going to be available to us in the future. So we hope our clients are going to take advantage of what's available now. And we thank you very much for your attention.
Any questions before we segue to our final presentation? Very good. Thank you very much. The takeaway is we have a window of opportunity when we know what rules we're working with. And as someone who does a fair amount of estate planning, you always like to get the most out of the valuations, the cost of the appraisals. So if someone wants to do sophisticated planning, we have a window to get it done so that you can use the same appraisal twice, end of December, early January, and hopefully the laws won't change before we can do that. So thank you very much. Appreciate it.